You know that feeling when you check your 401k balance and feel pretty good about yourself, like you're doing the responsible thing, saving for retirement, being a financial adult. I used to feel that way too, until I actually sat down and did the math on what I'd owe in taxes when I retire. And honestly, it was kind of shocking. Here's the thing. Nobody talks about when they're telling you to max out your 401k or get that employer match. They're not wrong, but they're only telling you half the story. The other half, that's the part about taxes that can completely change how much money you actually get to spend in retirement. Today, I'm breaking down the math that financial advisors don't always show you upfront. Not because 401ks are bad, they're not, but because you need to understand the full picture before you're 65 and realize you owe way more to the IRS than you planned for. Let me paint a picture. Let's say you're 30 years old and you're putting away $500 a month into your 401k. You feel good about it because that money goes in pre-tax. You're not paying taxes on it now, your taxable income is lower, you might even get a bigger refund. Feels like a win, right? Fast forward 35 years. You're 65. You've been consistent, the market's done well, and you've got $750,000 sitting in that account. That's the number you see when you log in. That's the number that makes you feel like you can actually retire. But here's what most people don't realize. That's not your money. Not all of it, anyway. The IRS is a silent partner in your 401k, and they're just waiting for you to start taking withdrawals so they can collect their share. Every single dollar you pull out of that 401k, that's taxable income. Not capital gains, not some special retirement rate. Regular income tax, the same rate you pay on your paycheck. So if you need $60,000 a year to live on in retirement and you're in the 22% tax bracket, you're not pulling out $60,000. You're pulling out more like $77,000 and giving $17,000 of it straight to the government. Suddenly, that $750,000 doesn't look quite as big, does it? Because depending on your tax bracket, the real spending power might be closer to $550,000 or $600,000. That's a six-figure difference that nobody mentions when they're hyping up the 401k. And here's the kicker. You have no idea what tax rates will be in 30 or 40 years. You're making a bet that taxes will be lower when you retire than they are now. But what if they're higher? What if you worked your whole life saving in a pre-tax account only to pull it out during higher tax rates? You'd actually lose money on that strategy. But it gets worse. There are tax traps built into 401ks that most people don't see coming until it's too late. First, required minimum distributions, or RMDs. Once you turn 73, the government forces you to start withdrawing money from your 401k, whether you need it or not. They've waited long enough for their tax money, and now they're coming to collect. The amount you have to withdraw increases every year based on your life expectancy. Here's why this matters. Let's say you've saved really well, and you don't actually need the money yet. Maybe you're still working part-time. Maybe you have other income sources. Maybe you just want to let it grow longer. Too bad. The IRS requires you to pull it out anyway, which means you're paying taxes on money you didn't even want to withdraw. And if you forget or refuse, there's a penalty of up to 25% of what you should have withdrawn. They're not playing around. Second trap, Social Security taxation. A lot of people don't realize that your 401k withdrawals can make your Social Security taxable. Up to 85% of your Social Security can be taxed depending on your total income. So you're pulling money from your 401k to live on, which increases your income, which makes your Social Security taxable, which means you need to pull out even more from your 401k to cover those taxes. It's this snowball effect that nobody warns you about. Third, you might actually be in a higher tax bracket in retirement. Everyone assumes they'll be in a lower bracket when they retire because they're not working. But if you saved really well, if you have a pension, if your spouse is still working, if you have rental income, you might end up with more taxable income in retirement than you had while working, which is the opposite of what you wanted. You deferred taxes from a lower bracket to pay them in a higher bracket. That's the opposite of what you wanted. All right, let's run some real numbers because this is where it gets eye-opening. Scenario 1. You put $20,000 a year into a traditional 401k for 30 years. You're in the 24% tax bracket now, so that $20,000 would have cost you $15,200 after taxes if you'd taken it as income. Instead, you defer the taxes. Assuming 7% average returns, you end up with about $2 million. Sounds great until you start withdrawing. If you're taking out $100,000 a year to live on and you're still in the 24% bracket, which is very possible with that much saved, you're paying $24,000 in federal taxes every year. Over a 25-year retirement, that's $600,000 to the IRS, not counting state taxes if you're in a state with income tax. Now, scenario 2, you put that same money into a Roth 401k or Roth IRA. You pay the 24% tax upfront, so you're contributing $15,200 after taxes each year. With the same 7% returns over 30 years, you end up with about $1.5 million. That's less than the traditional 401k, right? But here's the magic. When you withdraw from a Roth in retirement, it's completely tax-free. Every dollar you pull out is yours. No taxes, no RMDs forcing you to withdraw, no making your Social Security taxable, no tax surprises. That $1.5 million spends like $1.5 million. When you do the actual math, the Roth often comes out ahead even though you started with less, especially if tax rates go up or if you end up in a higher bracket than expected. And even if the numbers end up similar, the Roth gives you certainty. You know exactly what you have. No guessing about future tax rates, no surprises from the IRS. So, what do you actually do with this information? Should you abandon your 401k? No, but you should be strategic about it. First, if your employer offers a match, always get the full match. That's free money, even with the taxes. If they're matching 50% of your contributions up to 6%, that's an immediate 50% return. You can't beat that anywhere else. Second, consider splitting your contributions. Do enough in the traditional 401k to get the full match, then put additional savings into a Roth IRA or Roth 401k if your plan offers it. This gives you tax diversification. Some money you've already paid taxes on, some money you haven't. In retirement, you can strategically pull from each account to manage your tax bracket. Third, understand that the right answer depends on your specific situation. If you're in a very high tax bracket now and you're confident you'll be in a much lower one later, traditional might make sense. If you're early in your career and in a lower bracket, Roth is probably your best friend. If you're unsure, diversification protects you both ways. Here's what I want you to remember. Your 401k balance is not your retirement money. Your 401k balance minus taxes is your retirement money. Those are two very different numbers, and planning for the wrong one can completely derail your retirement. The goal isn't to avoid 401ks or to be fearful of taxes. The goal is to go in with your eyes open, to make intentional choices instead of just doing what everyone says you should do. Because when it comes to your money and your future, you need to see the full picture. Run your own numbers, talk to a tax professional if you can, and make sure the retirement you're planning for is based on what you'll actually have to spend, not just what the account balance says. If this changed how you think about retirement planning, hit that subscribe button. Drop a comment if you have questions about traditional versus Roth, or if you've discovered these tax surprises yourself. I'll see you in the next one.